Most people hear trend following strategy that actually works and think it means buying something that is already up and hoping it keeps going. That is too vague, and it is why many beginners fail. A real trend following strategy is simple. You join a move only after price proves it is moving, then you stay in until the move breaks. The part people miss is that the method is not about being right often. It is about surviving the small losses long enough to catch the few moves that pay for everything else. I'll show you the exact mechanics that matter, because the difference between a workable trend system and a random chart guess is usually very small. At the core, trend following is just a rule set for avoiding emotional entries. You define a trend in plain language first. Price is making higher highs and higher lows, or lower lows and lower highs. Then you use a trigger to enter. That trigger can be a moving average break, a breakout above recent highs, or a pullback that holds above support. The tool is not magic. It is a filter. It tells you when the market is acting in a way that gives the trend a chance to continue. Without that filter, traders confuse movement with direction and get chopped up. Here is where most people go wrong. They want the perfect entry, so they buy the first green candle or short the first red candle. That is not trend following. That is impatience. A workable approach usually accepts that many entries will be a little late. That is fine. Late is often better than early because you need evidence, not hope. I also think beginners underestimate how much the exit matters. A trend strategy is not just about getting in. It is about staying in while the move is healthy and leaving when the market tells you the trend has weakened. The simplest exit rule is also the one people resist most. Cut the trade when price closes back through your trend line, moving average, or breakout level. Some traders use a trailing stop. That means the stop moves up as price moves up, so profits are protected without trying to predict the top. In plain English, the stop is there to keep one bad reversal from turning into a big loss. The formula behind a trailing stop is not important as math. What matters is that it gives the trade room to breathe, but not unlimited room. A trend-following strategy that actually works tends to do well when markets are directional and persistent. It struggles when price is flat, noisy, and mean reverting. In a sideways market, breakouts fail more often, and you can get a string of small losses. That is normal, not a sign the method is broken. The method only makes sense if you accept that you are paying a small cost to stay exposed to the rare trend that runs much farther than expected. If you cannot tolerate a long stretch of mediocre results, trend following will feel frustrating very quickly. The practical version is boring, and that is a good sign. Pick one market, one time frame, one entry rule, and one exit rule. Measure the average loss, the win rate, and the size of the winners. If the winners are not bigger than the losses over time, the system is not really trend following. It is just active trading with a trend label attached. My view is blunt here. The strategy works best when it is simple, disciplined, and built around risk control. It fails when traders keep changing the rules every time a trade loses. The edge, if there is one, comes from consistency.